A good looking market breadth once again. It's Yes Bank because they've got insurance license. The stock is up 4-5 rupees, but that's about it. Shyam Sekhar joins us with his thoughts on where we are headed. Okay, Shyam, glass half full, glass half empty. What is your view? Do you think now there could be what we've seen in last 3 months is an excruciating fall? Do you think next 3 months we could see a reverse of that stability and reversal, stability and absolute gains?
I definitely don't foresee absolute gains from here. Reversal is also probably a best case scenario. Here is why. I think that we have given a higher valuation to the mid caps and some parts of the market while ignoring the overall market trade. And you are seeing that active investing is at its worst crisis today, be it large cap or mid cap. And I only expect this crisis to get worse as active investors and managers, me included, will have our challenges in trying to decipher and realign our actions towards the macro changes that are happening in the economy. So I think that clearly portfolios are not prepared for the kind of macroeconomic changes that we are seeing now and we are likely to see in the next 3 to 6 months. So I think this portfolio change has to happen. When that portfolio change happens, I think there will be a impact cost on portfolios, large, small or medium. And only after this impact cost is absorbed and the performance starts to show in the realigned portfolio, you can have positive returns. So I don't see much scope for that over the next 6 months.
What is going to be the nature of this continued fall? Do you think there is more price damage left in the broader markets, or is it going to now only be a time-wise correction wherein the large part of the damage is already behind us?
I think we are heading towards a phase of disclosure damage, not price damage. I think the valuations have been given to businesses without measuring governance very tightly. And I think the disclosures will send us back to the table to measure governance with a stricter yardstick. And this will definitely soften valuations in several companies which have been market favorites over the past year or two. So that is going to impede returns. That is what I expect.
Whereas I know there is this entire thought that money should move towards passive investing, active investors underperforming. I was just looking at Nifty data and the fund performance data for last 10 years. And I think 10-year and 5-year are two reasonable pockets which I look at in terms of judging a cycle. On a 10-year basis, most of the active fund managers or worst of the active mutual funds have done much better than the Nifty. And on a 5-year basis also that data is same. So whereas I know there is right now a kind of huge crack in the mid and the small cap space, and the pains and the gains are pain is back and gains are gone. To assume that there is going to be a big systematic change, I think it's too early.
I'm not expecting a systemic change. I am with you on the fact that active managers will do well over the long term. But what I'm seeing is that in the next 6 months, active fund managers have challenges which they cannot overcome within such a short span of time. I believe that whoever it may be, however talented a manager may be, I think the active investing has gone in a certain direction. It has gone a little too far in that direction. It has to come back to a certain midpoint and then go in a new direction. I think that the impact cost of this is something that we cannot ignore. That is my simple point. I think that if you look at the long term over the next 3 years, I'm quite sure that several active managers will widely outperform the benchmarks, whichever may be the benchmarks they take on. But over the next 6 months or 1 year, I don't expect this to happen. I think the challenges are far higher. Even today, the active managers who seem to be outperforming are doing it on the strength of two factors. One is they still have flows which help them to support their portfolios or the investee companies in their portfolios. The second is they have invested in companies which are rather illiquid, where the valuation doesn't fall so easily. So I think that these two are likely to change. Flows can change, and liquidity can arise in a company all of a sudden. That is why we have seen several companies fall by 50% after going up several times. The fact is that liquidity suddenly emerges, then you have these issues that shake the confidence of people, and then liquidity rises significantly, and then valuation cracks. I think that this challenge is going to show up in several portfolios of active managers, and there is no escaping this. This is why I feel that in the near term, active managers are unlikely to outperform their benchmarks.
Shyam, the only follow-up that I have to what you're saying then is, let's talk about the individual sectors where you're taking a view right now. Private banks, you're saying the valuations there are looking rich. Now, that's something that's well documented in the market. I mean, everybody keeps talking about why HDFC Bank is nearly at 4 times book, but the appetite for that bank in the market continues to soar. If private banks are looking rich to you, what is it that you're propagating? Switch from private banks into corporate-oriented banks or PSU banks or NBFCs, or continue to buy them for the certainty of growth that they offer?
See, I think that I look at banking very differently right now. If you look at banks, or if you look at the private banks, what really gave them this position? The fact is that they had very good fee-based income. So, and they have grown this fee-based income tremendously over the last decade. Now, over the next decade, I expect that the companies that gave them this fee-based income are likely to do better. They are all coming public. Today, you have asset management companies, you have insurance companies, you have stock exchanges. You have several options before you to play the same team. And I would think that I would rather play the teams through those entities than through the private banks. And the second thing is the private banks have their own recapitalization imperatives. They have their capital raising imperatives. If you take HDFC and Kotak, they have specific imperatives of raising capital or reducing promoter stake. These are things that will significantly satiate the appetite for their stock. That is one aspect. The second aspect is that I think the active managers have been holding these stocks up. And I would think that that will also not be so easy going forward. So when there is supply, I think that these will soften in valuation. So I don't see any need for being euphoric on private banks. I would rather shift my focus to the other businesses which the private banks have benefited from, which also have similar growth in fee-based income. And I think that those themes are the ones that one should look at going forward. I would play the same financial theme very differently. That is my basic point.
And how is it that you propose to do that?
I told you there are several new companies that are going public in the space of asset management. You already have a few, you'll have more. These companies will see their prices discover on the stock market and stabilize at some point in time. At that point, I would definitely look to scale up my investments in them. I also mentioned private insurance as a play. You have life insurance, you have general insurance, you have health insurance. So you have three spaces which are relatively nascent and which are very strong growth engines going forward. I mentioned the stock exchanges. You already have commodity exchanges, you have stock exchanges. I think these are businesses with very good networks, long runway. There are a number of such opportunities in the financial space. I would think that banking is relatively unattractive when compared to these opportunities.
Well, I'm going to mark Shriram Transport and Shriram City Union. Shyam, a company up your alley, which is regarded for its corporate governance. Mr. Tyagarajan and the way he's conducted business, markets have admired him both for his approach and for his consistency. And market discovered yesterday that Shriram Transport is no different. In order to make up for their infrastructure, so EPC businesses, they were also forced, or they were also obliged to give a bank guarantee. Is this going to remain like a black mark for Shriram group of companies?
Without getting specific to the transaction, let me say this. I think that we should not mix up personality with governance. I think that that is something that I think has gone a bit too far on this. In the end, an NBFC lending to truckers is a subprime business. So it doesn't matter who does this business or what are their personality traits or what are their personal values. I think that that business is bound to have its challenges. Leveraging that business to get into other unrelated businesses is again a second level speculation. And I think that that speculation is bound to come back to hurt sometime. In the end, even if assume that the company was very good at one business, that does not make it a candidate to enter other businesses in which it does not have any history or domain expertise or have the kind of management personnel to take it to the next level. So in that scenario, I think institutional investors have oversimplified their assessments and not really paid heed to what were the structural risks of the group. I think that I would only advise that you still look closer at the structural risks of a company with strengths in one business, which is actually a subprime business, leveraging it and entering several other businesses. Who the owners are, what the board is, what are their personal standing, what is their personal standing, these things really should not influence our judgment. I think we have to look at it as a generic situation, and then I think clarity will emerge.
Will that apply to other so-called South Indian conservative groups, the Sundaram group, the Murugappa group? I mean, all of them have SME exposure, they have exposure to the CV cycle. You know, as a pure market commentator, I've always admired the kind of corporate ethos some of these companies have followed, both in terms of capital allocation. So do you think now we need to really look at concerns which could emanate from some other stronger names also?
I would look at any company from the point of view of disclosure, transparency, and business mix, and their core competence. These are some of the things that you need to look at. If you look at Sundaram, they have not really gone into businesses which are not part of their core competence. They have taken a long time to decide to enter into any new business. And it has been the higher shareholders saying that they are too slow. If you take Cholamandalam, they had one bad experience earlier from which they have come out. Now they are going into the next phase of growth. I think that you should constantly watch what business is bringing in the money and what are the structural risks in that business. You cannot take financials as one business. I think you should see the subsets within financials and see how the risks are panning out, and then form your investment judgments. I would not like to say that South Indian business groups are conservative or that you cannot expect anything to go wrong. These are all generic judgments which don't have any basis except your perception of people. I think that you have to look at governance and risks in every company dynamically. I don't think we should have such generic judgments anymore. We don't live in such times anymore.
Was a South India based company, Nikan, just a reminder.
No. I mean, when I say South Indian based companies, I'm generally referring to, you know, if you really look at the track record of Chola, you look at the track record of what
the Murugappa group.
I mean, Chola has Murugappa, the same, what Sundaram group has done. I've liked the way they've been conservative about their capital allocation. These are not the companies which are giving you 50%, 80% growth, but they've survived and they've seen cycles, and they've not had too much of, and they managed to grow without raising too much of capital. They managed to have one main business which has incubated other businesses, and those other businesses have also managed to grow very handsomely. In a bad cycle, the NPAs are low. In a good cycle, they may not be the best one to grow. So they may not give you this huge CAGR growth, but
they're steady compounders.
They are steady compounders. You have to like I like the way that they've not really burnt money in businesses which are new age businesses like e-commerce or TMT or telecom. For me, that is good corporate governance, great capital allocation. You treat minority shareholders with respect, and you read the balance sheet of some of these group companies. They are very vocal. For that matter, even the TVS group, they are in the auto ancillary business, which requires a lot of capital to grow. But the way they've managed to grow a Sundaram Fastener or how TVS has made a comeback, you got to admire about these things about them. It's just a coincidence that they are part of South India. But then you got the Hyderabad promoters, and we've always raised question marks about what's wrong with people in Hyderabad. So I'm not going to go beyond that. It could be a coincidence, but it is true so far.
Let's not generalize any of these regions.
Absolutely.
Okay.
You know, I just wanted to ask Shyam about ITC and Bata. You're saying, Shyam, that these are the large cap consumption stories. However, the market has not been able to capture the the kind of upside potential that there could be in these businesses. I'm not saying that the market has not given ITC and Bata their due. But for example, with ITC, I don't know whether the shift and the premiumization to moving towards an FMCG dominating business model has happened to the market's mind. And even with Bata, I mean, we still think that they are in the low product value they're in the low value product offerings at this point in time. But there's a big scale up that's happening at Bata with their recent advertising campaign. So when do you think the market will really capture that transition?
I don't agree with your view that Bata has not captured, market has not captured this, because 2 years back Bata was 430 rupees, today it's 840 rupees. So the market has definitely captured it. It's just that we have started noticing it late, and that is all there is to it. The market has definitely taken cognizance of what is happening, and you have to understand one thing. The average realization per unit of sale has to go, if it goes up by 100 rupees, it can really create a massive multiplier in the P&L of these kind of companies. I'm talking about Bata specifically. But however, at this point, valuations definitely look a bit stretched, and I would keep a watch for any other market situation which will give the stock at a relatively lesser valuation to enter. But it's a fantastic company with great scope, and can be a very good compounder over the next 5 to 7 years. I think the GST is again something which will benefit this company enormously. And I also see that migration and social mobility is going to help this company. The company is also taking active steps to rearrange its store portfolio. Like, they are shutting a lot of stores in bad locations, opening stores in newer formats. The real estate market is also very conducive to expand the business. They are not even there in the digital, in the online retailing. So that is another segment where they need to do a lot of work. So it's a lot of heavy lifting for sure. But I think the size of the opportunity is simply enormous to ignore. In the case of ITC, I think that the market is not going to easily take cognizance of ITC's problems. That has been the history of ITC. In the last 3 decades that I have been an investor, ITC always had its challenges. And the markets for a very long time never believed the company would overcome them. And then when it was convinced that the company had overcome them, it quickly re-rated the company. And that is how it has grown from a very rather moderate valuation in 1990 to what it is today. So I think that the company has a very solid core business. It's not going away. And it is investing in several businesses, which are also reasonably great opportunities for growth. And I think that the company is in a good position to stabilize this and prove that it can run those businesses.
Shyam, so closing comments, we've talked about commodities, and you've said that you like commodity stocks also. But of late, there is a bit of a crisscross on which way commodity cycle is headed, given that the trade war, it's no longer a fear. The trade war is real, and directly, indirectly, it will have an impact on global demand. The optimist would say that the impact would be less. The pessimistic would say that the impact could be more. But there is a case of disruption at global level. The demand indicators could slow down. So what happens to commodities in this kind of an environment? And I think you like ferrous more than non-ferrous. So let's be more specific here.
Nikunj, we have to understand what will be the stand taken by a government in the event of a trade war. It is amply clear that the Indian government wants to be self-sufficient in its need for metals, both ferrous and non-ferrous. It's quite clear. And post resolution of the larger NCLT matters, we are going to have a lot of capacity which will come into production. So we don't really need to import. With the floor price being already set for imports, I don't expect the government to play it soft and allow imports to come and affect the prospects of domestic industry. This is as far as the ferrous metals are concerned. In the case of non-ferrous metals, I think that the demand is definitely going to be strong, and we are going to see a macro growth and a better rural growth, leading to a lot of spending and a lot of investments in several areas across the spectrum. So I expect that the demand for ferrous and non-ferrous metals to be strong. I expect the government policies to be supportive. The problem with the market is we trust the government when you should not trust it, and we distrust the government intensely even after the government has made its intent clear. So I think that it is we who need to learn from our past mistakes and try and reset our expectations out of government and move on. I think that the biggest thing that I have seen with commodities in the last 1 year is that market has shown very, very poor judgment of what is government's intent. I think that if this judgment improves, I think our investing in commodities will improve, and there is a lot of money to be made in them. The problem is that we want to rush into the wrong judgments and then stick to them. That needs to be changed.
Fair point. Shyam, pleasure speaking with you, and thanks so much really for sharing your wisdom on what the market texture is like, what should we bet on from here onwards, and more importantly, this mid-cap carnage which has been playing out. And that's really our endeavor at ET now, to throw and highlight what's going on with the mid-cap end of the market in our special series, Mid-Cap Magnifier.